Namaste and welcome to part E of cash flow under simple solution series. This is part E of the series. We have already seen A, B, C, D. Based on what we have done in the first four parts, we should be able to formulate process guidelines for us to solve a problem. Now this slide aims to summarize the entire process of cash flow preparation under Accounting Standard 3 or AS3. Now, what AS3 expects us? It expects us to report flow of cash under three heads: operating activities, investing activities, and financing activities. And what does it expect us to do? It says you show me cash profit under operating activities. Under investing activities, you show us cash flow resulting from fixed assets and investments. Under financing activities, show us regarding debt and equity and premium on issue or premium on redemption. Therefore, our final output has to be a combination of these three, duly segregated and refined. You will ask a question, where do we get this operating cash profit? What we get normally is a profit and loss account and two balance sheets at two different rates. What will be there in the profit and loss account? Profit and loss account is a combination of cash transactions and non-cash transactions. But what we need for a cash flow is only cash transactions. Therefore, step number one, when we go through profit and loss account, we need to ensure that we identify the non-cash transactions, which are depreciation, a book entry, write-off of fixed assets, a book entry, preliminary expenses write-off, a book entry, and transfer to and from general reserve, redemption reserve, or reserves of similar type. These four transactions we need to identify. Why? Because we want them to be not there in our cash flow. Therefore, we are going to remove them. First step in cash flow preparation is remove non-cash transactions from profit and loss account, which are depreciation, write-offs of fixed assets, preliminary expenses, and transfers to and from general and redemption reserves. This is first step. Okay, first step is remove. What is the second step? Now, once you remove non-cash transactions, you are left with only cash transactions. But what AS3 expects us is, it wants cash transactions to be presented under three separate heads. But our profit and loss account clubs everything together. What we will do now is, in the profit and loss account, we will keep only operating details, and anything pertaining to investing and financing, we will remove. And what we will do after removing them? What are those items? They are four items: profit or loss on sale of fixed assets, profit or loss on sale of investments, dividends or interests received, and dividends declared, interest paid. One is inflow, the other one is outflow. And in this case, it is profit or loss. These four transactions we have to identify. In the cash transactions, we remove it because it is not belonging to operating activities, because one belongs to fixed assets and investments means it belongs to group 2. Third one is dividend and interest. It is pertaining to debts and equities. It belongs here. Means in effect, we are going to shift this from operating activities to the other two groups. This is what we are going to do. Profit and loss, fixed assets and investments, we will relocate to here. We relocate it here. Dividend and interest received. When you receive this, this is on Your investments, if you have invested in equities, you receive interest on that, sorry, dividend on that. If you have invested in debt equipments, debt instruments, you will get interest. Both these belong here. Therefore, remove from profit and loss account, post it under investing activities. Therefore, investing will have initial direct transactions. Subsequently, it will have sale proceeds of fixed assets, investments, and income on fixed assets and investments. Then we have one more item, which is dividend. It is a cash transaction. Dividend and interest. Dividend proposed is on equity. Interest paid is on the borrowings. This will be posted here. This is stage number 1. You remove non-cash. Stage number 2, you have removal of cash transactions for their relocation into other 2 categories. Then we have got the next step of, within this you have got one specific item, which is income tax provision. It belongs to all of them because it is for the entity as such, but for the our convenience and as suggested by AS3, we will be showing income tax paid under operating activities as a separate item. It will always be there as a provision for income tax. We remove and then shift it and represent it in the same group as income tax paid. Now, just to tell you now, at the end of cash flow, what you will have with you? You will have under 3 broad categories, 3 funnels: operating activity, investing activity, financing activity. In operating activity, there will be mainly 3 items: operating cash profit, changes in working capital. Number 3 is income tax paid. Second, it will be having purchase of fixed assets and investments, sale of fixed assets, sale of investments, dividends and interests under investing. Number 3, cash flow from finance activities, issue of shares and debentures with the premium or without premium, redemption with the premium, without premium, and dividend and interest as proposed. All your activities under cash flow preparation has to fit into this. There can be nothing outside this. There can be details, breakups, but the process is the same. First, remove non-cash, remove cash and relocate it into 2 groups, then represent. This is the crux of the entire cash flow. We will take up today illustration 22 on page 309 of CMA study notes for understanding how to build a cash flow. And when we see this, even in the question papers, we need to have an initial review to understand how complicated it is and what are the issues involved. First one, we have 2 years. We have to first see the alignment of column, so that we have to deduct one from the other to find the increase or decrease. Current year is 2016 is the second column and 2015 is the first column. That is essential. Currency across is all rupees. There is no rounding off. Now, it just says you are required to prepare a cash flow statement. As we know, for operating activities, we have 2 methods of direct and indirect. When nothing is given specifically, it is always convenient and safe, and it is also expected to have operating activities cash flow under indirect method. Working note. Basically, we need to have a look at the whole thing to find out what are the unique features of this problem. It takes hardly a minute. First adjustment, preference share capital was redeemed at premium of 10%, partly paid out of proceeds of issue of equity shares. Means there is redemption of preference shares. It is paid out by issuing equity shares and also by paying out of bank account. Okay, multiple modes of repayment. Then the company purchased a plant and machinery for 95,000. Fair enough, purchase of assets. It also acquired another company, means there is an acquisition. Acquisition of a company. And it says another company, 25,000 was good stock, 1,05,000 was plant and machinery, means total assets was 1,30,000. But they paid 1,60,000 and paid 1,60,000, means a company worth 1,30,000 was purchased with the assets worth 1,30,000, but the consideration was 160, means we paid the balance 30,000 as goodwill. This is what we need to understand basically. Then here once again we have to just see short-term investment less than 2 months. When we say cash flow, we say cash equals cash balance plus cash equivalents. Cash equivalent is defined separately as one which is easily convertible into cash in a very short period. And here we are talking of less than 2 months. We can consider this as equivalent to cash. It is a cash equivalent. Therefore, what we will be taking it is we will have opening and closing balance of short-term investment clubbed with normal cash balance, and both these put together will be cash plus cash equivalents. That is what we need to look into short-term investments. We have seen cash flow process guidelines and we have an illustration now with us. Before we get going, it will be quite appropriate to link each item to the 3 activities so that we have an overview for a grasp of the entire problem. This is an attempt to do that. Let's get going. Let's say first preference share capital, it goes to financing activities. We have equity capital, it goes to financing activities. Share premium account, financing activities. Capital redemption reserve, we will be taking it under operating activities for removal. It is item number 4. Then general reserve. Once again, reserve of any type, it will be covered under item number 4. Profit and loss account will be the first item when we segregate non-cash items, and it will come under operating activities. Current liabilities is a part of working capital, therefore it will come under operating activities. Proposed dividend is actually coming here, dividends and income, sorry, it is number 4. Dividends and interest proposed or paid, it will be removed from here and it will be transferred, relocated to financing activities. Similarly, provision for tax, as we have seen, provision for tax will be reversed in operating, but it will be represented as income tax paid. It will remain in the same, but it will be presented. Let's come to asset side. Plant and machinery will come to investing activities. Long-term investment will come to investing activities. Goodwill, it goes along with fixed assets, therefore investing activities. Current assets is a part of working capital. It will come under changes in working capital. Short-term investments, we saw cash equivalents definition, short-term highly liquid investment that are readily convertible into cash. Therefore, it will go as a part of cash balance. They will be clubbed together, although given as 2 separate heads. Preliminary expenses is an expense which is capitalized coming under investing activities. That way, we have established link as to where these items are to be treated. Now we are at the starting point. We normally start with the first item in the workings is profit and loss account balance. How do we do that? Opening balance of 1,30,000, closing balance of 1,75,000. Profit and loss account, there is an additional profit of 45,000 during the year. Profit and loss account balance, difference between the 2 balances, we put it here. That is the first item of entry in the profit and loss account as shown under first item in the cash flow statement. It would be quite interesting at this stage to learn more about items in the adjustment. Let me just see. Preference share capital was redeemed at a premium of 10%, partly out of proceeds of issue of 10,000 shares of rupees 10 each, at a premium of 10%, and partly out of profits otherwise available for dividend. Number two, company purchased plant and machinery 95,000. It also acquired another company's stock 25,000. Machinery purchased 1,05,000, paid 1,60,000, and it paid by issuing equity share capital. Now, if you look into these details, you will find we have got preference share capital which is involved here. We have preference capital redemption account involved here. We have got equity share capital. We have got a share premium account, and we have bought stock of 25,000, and we have got plant and machinery also acquired. We have paid more than the asset value. We have a goodwill. Now a question comes in your mind, why prepare so many accounts? It is already there here now. We know preference share capital has gone down by 2 lakhs. If I pass an entry based on this, I'm ignorant about I have paid a premium on that redemption. That for that purpose I need to just have properly put in one place, not to have memory used for that purpose. Second, equity share capital is growing up by 2,60,000. 4 lakhs to 2 lakhs. I can straight away take 2,60,000, but I should know what is that 2,60,000 coming from? Is there any gap? Plant and machinery, 7 lakh became 1 lakh, 8 lakh 20,000. Means it has increased by only 1 lakh 20,000. Whereas here he has purchased 1 lakh 5,000 and also 95. When you purchased 2 lakh worth investments, fixed assets, why your investments went up only by 1 lakh 20,000? These issues are to be addressed. And long-term investment 3 lakh 20,000 became 4 lakhs. Means where is that amount of long-term investment? And there is a goodwill of 30,000. Where did it come from? All these questions are to be understood before we solve the problem. That doesn't mean you will have any figure extra coming from these workings. No, but you will come to know that everything is properly balanced. What if something is not properly balanced? Then we have to give a name to the deficit, or we have to give a name to what is the gap. That will be the advantage of preparing these accounts. If we do this, you will realize that this stage is avoidable, but it is useful for us to have a grip on the solution. How does it work? Let me just say first, it talks of you have got 4 lakhs of preference share, 50% you are redeeming. It says 50%. The preference share redeemed at a premium of 10%, partly out of proceeds of issue of 1 lakh. Why it is only 50%? Look at this. 4 lakhs is the balance. Closing balance is 2 lakhs. Means what is redeemed is 50%, 2 lakhs. 10% premium means totally 2 lakh 20,000 is supposed to be paid to them. But what has happened is that whatever you pay out, you have issued only 10,000 equity shares. 10,000 equity shares comes to 1 lakh 10,000 into, and it is issued at a premium of 10%. Means 1 lakh 10,000 out of 2 lakh 20,000 is by way of issue proceeds. Balance 1 lakh 10,000 is paid directly from the bank. That is what he says here now. Understand this, there is no account to be prepared. Partly out of profits otherwise available for dividend. What do you mean by profits otherwise available for dividend? It is available with you in terms of bank balance, and it is paid out of bank. Therefore, the first transaction of redemption is 2 lakhs. Starting here, 2 lakhs is paid out. Out of 2 lakhs, 10% premium, 2 lakh 20,000. 2 lakh 20,000 is paid. 1 lakh 10,000 is 1 lakh capital. 10,000 is premium is paid out. Balance 1 lakh 10,000 is paid separately out. Therefore, we have no special things to note here. It is already covered under 2 lakhs and there is a share premium of 20,000. Means what we pay him out is 2,20,000. This is what we are going to suggest here. 2,20,000 is the total outflow. Then second point is the bank purchases. 95,000. Company purchased plant machinery worth 95,000. We have seen the transaction involving redemption of preference shares. Second point is the company purchased plant and machinery worth 95,000, which will come as a debit to plant and machinery account. And how it was paid? Company purchased means it is paid by bank. Okay. Then number 3, the company paid 1,60,000 against purchase of stock of 25,000 and plant and machinery of 1,05,000, means the balance was goodwill of 30,000, and this was the transaction cycle. Addition to fixed assets 1,05,000, additions to current assets 35,000, goodwill fixed assets 30,000, payment made 1,60,000. There is no gap. Now we have seen all these accounts. We don't find any gaps as such which are arising or which are coming to light after we prepare the account. But come to profit and loss plant and machinery account. 7 lakhs opening balance, 95,000 plant and machinery purchased by bank payment, 1,05,000 plant and machinery by issue of capital, 1,60,000 shares issued. Total is 9 lakhs. We have a gap of 80,000. Now the question that comes here is, what is this gap? We have purchase. This cannot be a sale. And we have seen in our guidelines, one of the non-cash items is depreciation. This particular problem is silent about depreciation. We have to give this gap as a depreciation provision, and that is our gain from preparing these accounts. Now, based on these accounts that we have prepared, preference share capital gone down by 2 lakhs, and we have paid a premium of 20,000 on its redemption. Fine. Then equity share capital went up by 2,60,000 because we issued shares. Now we are coming to share premium account, which has gone down from 40,000 to 30,000. Means there is a net in outflow. In the sense, opening was 40,000, it became 30,000 because we paid a redemption premium on preference shares 20,000. We received 10,000 as premium of 10% received in respect of 10,000 equity shares. We have to account the difference, that is 20,000 what we paid and 10,000 what we received. As you will observe, when we redeemed, we have accounted for the 20,000. Now this is the time to account the balance of 10,000 which was received. Payment has been recorded. Now receipt has to be taken on books. As you will see, 20,000 is already accounted. Now 10,000 premium received has to be shown. In effect, we will be accounting for the net 10,000 fall in the share premium account. Have a look at capital redemption reserve. It was 0. It came to 1 lakh. Means 1 lakh was transferred from profit and loss account to capital redemption reserve. As per our guideline, if something was transferred before, it has to be reversed. When it was transferred, it was deducted from profit and loss account. Now we will be adding it to profit back. And that is how we give effect to this. We remove it, remove the effect of the transaction by doing a reverse entry. General reserve, it was 2 lakhs, it became 1,20,000, means something was transferred from here and it was added to profit. Now we reverse it. Earlier it was added, now it is being reversed, therefore minus 80,000. Current liabilities. When the liability of yours goes up, means you have received funds from them. 6,40,000 becomes 9 lakhs, means there is an inflow to the extent of 2,60,000, which we show it under working capital changes. Now we are looking into proposed dividend. You need to have 2 points noted here very specifically. When we treat current year's provision and previous year's provision in a special way. What is the special way? Current year's provision, which is made 2,10,000 proposed dividend, when it was proposed, it was deducted out of profits. Now we will add it back. Second, previous year's dividend we normally consider as dividend paid. Provision is reversed. Previous year's provision is considered as dividend paid, and we call it as dividend paid, and we relocate it. We relocate it under financing activities because it is a dividend paid on equity. These 2 points we have to note a difference. It is not the difference between 2,10,000 and 1,60,000. We simply take it as incremental dividend. No, we treat current year's provision separately, previous year's provision separately. Previous year's provision is relocated and called as dividend paid. Current year's provision is reversed out of current year's provision. That is current year's profits. Let's go ahead and then see how it is coming out. 2,10,000. It was deducted before. Now we are reversing it. 2,10,000 is added back. Then we had a provision of 1,60,000. We will take it for relocation. We call it as dividend paid, and the transaction is completed. Just like we saw in respect of proposed dividend, in case of provision for tax also, we should not take the figures straight away. It helps us to prepare a ledger account because we are supposed to find out what was debited to profit and loss account and what was the actual payment. Now, whatever is actually debited is a provision which we are going to reverse. And as per the guidelines, we are supposed to show tax paid, income tax paid under operating activities as the last item in the group, just like income tax paid. Let us take the practical example and see the provision for tax account. How do we proceed? Opening balance is 1,50,000 credit balance. Closing balance is 1,80,000. Then the company paid tax of 1,40,000. It is very clearly indicated. When we relocate, we show this as income tax paid 1,40,000. Then if 1,40,000 is paid, 150 is opening balance and 180 is closing balance, the difference has to be debit from the current account, current profit and loss account. Therefore, 1,70,000 is the gap. This gap has to be reversed because it was charged to profit and loss account. When we charged the tax, the profit came down, and when we reverse it, it has to go up. Therefore, we add back provision for tax 1,70,000, which was the charge against profit and loss account this year, will be added back to profits. And as per the guidelines AS3, we will show whatever tax paid 1,40,000 as tax paid during the year as the last item under operating activities. Now we are at plant and machinery. As you will observe, plant and machinery is 7 lakh opening, 8 lakh 20 closing, means there is an addition of 120,000 during the year. But as we find, we purchased plant worth 1 lakh 5,000 and 95,000, effectively 2 lakhs, and we had a depreciation of 80,000. Net between these two is 1 lakh 20,000. We will be passing two entries, one for accounting for addition to fixed assets, second an entry for depreciation. Depreciation will be a reversal in operating activities, and addition to fixed assets will be an outflow under investing activities. And this is how exactly we will be taking care of this 1 lakh 20,000. Let's get going. 95,000 and 1 lakh 5,000 is 2 lakhs, which is shown as purchases of assets made, plant and machinery, under investing activities as outflow because the money is paid by. Having recorded the investment of 2 lakh rupees as outflow, now we record the depreciation of 80,000. As per the guidelines, it has to be removed because it is a non-cash expense. That is what we will be doing. When it was charged, it reduced the profit. When we are removing it, we are adding it back to profits, and that covers the account of plant and machinery net addition of 1 lakh 20,000. Now comes investments, which has grown from 3 lakh 20,000 to 4 lakh, net increase of 80,000, which is a simple and straightforward case of additional outflow of 80,000 as investment made, which will be shown under investing activities. That's it. We purchased goods and paid, creating a goodwill account. Goodwill, which was 0 before, it became 30,000. There is an addition of goodwill. It is an outgo because we have paid out 30,000 for no assets received. Then we have current assets are a part of working capital. Current assets have gone up from 9 lakh 10,000 to 11 lakh 40,000. When your current assets go up, you invest your money, means there is a funds outflow. 9 lakh 10 to 11 lakh 41,000 is 2 lakh 31,000, which is effectively we paid the 25,000 when we purchased the stock, and balance is the gap. But both put together, 2 lakh 31,000 is the amount of current assets built up during the period, which is Now we will be dealing with the transaction of foreign exchange loss of 1,600 represents loss in value of short-term investments. The trickiest part of this is an investment loss. Normally what we do, as per the guideline, first the loss has brought down our profit, we remove it and add it back to profits. Second, we show the sale proceeds as an outgo in the investing. Logic is the same. 1,600 has to be added back to profits. But when you have to show it as an outgo, where do you show? Do you show it in financing? No, it is not a part of equity debenture. Do you show it in investments? No, it is not a part of investment. It is a part of cash balance of cash and cash equivalents. Therefore, we have no issue so far as removal of it as an extraneous item from the profit and loss account. Our issue is as to where it has to be posted as an outflow. Since investing and financing are not the two right places for it, we can put it under working capital show it as a part of operations only. Whatever loss is there, we will write it back adding to the profits, and we will also show the outgo as an outgo under working capital changes. That will be an acceptable form of presentation. Let's go ahead. 1600, it was charged as loss, it brought down profits. Now we are reversing it, adding it back to profits. Then we treat it as an investment lost, means it is an outgo. We will be showing it under the same operating activities as an outgo of 1600, which will be an acceptable form of presentation. Having covered other assets, we are left with the closing cash balance and also preliminary expenses. Let us take up the cash and bank balance now. As cash and cash equivalents, we have to post at this stage what is our opening balance, which was impacted by the cash flow to take it to the closing balance. That is 1 lakh plus 50,000. 1,50,000 is cash and cash equivalents. Preliminary expenses is the last item in the balance sheet. It came down from 40 to 20,000, means during the year 20,000 was written off, which brought down our profits to that extent. Now, as per the cash flow guidelines, we are supposed to remove non-cash expense. Preliminary expenses is a non-cash expense. That 20,000 which has reduced the profit, when it is removed, it adds to the profits. 20,000 is added back. We have covered both asset side and liability side of the balance sheet, starting from preference share capital to preliminary expenses. We have covered all the additional information, and we have also posted the opening balance of 1,50,000. Now is the time to strike subtotals and derive the closing balance as per our cash flow statement summary. Non-cash expenses, working capital changes, total cash generation, and net cash flow from operating activities is 4,34,000. Investing activities, our outlay was 2,80,000. From financing, issue of shares, redemption of shares, goodwill, as well as dividend paid, 1,40,000. Net increase in the cash and cash equivalents is 14. Opening balance was 1,50,000, which takes us to the final closure balance of 1,64,000, which is equal to, as per the balance sheet, cash is 80,000 and cash equivalent 84,000, 1,64,000, and that perfectly balances the two as a solution to the problem. Thank you so much. Thanks a lot.